Welcome, everyone. Welcome to our Penn Society members and guests. I want to send a special welcome to new Penn Club members. I know there's a few of you. This is your first meeting as members of the Penn Club, and I want to welcome you especially. Thank you all for zooming in. I'm Dorothy Nicholson, chair of the Penn Club Hedge Fund Bulls and Bears Society, one of the oldest societies at the Penn Club. I'm very excited to say we have a guest speaker tonight who's going to talk to us. Before he takes questions, he's going to talk to us on ways to successfully raise hedge fund and alternative investment capital, even now during the COVID pandemic. Evan Katz is a managing director at Crawford Ventures, Inc., a Wharton alumnus, and an award-winning industry media recognized expert regarding hedge funds, investors, and large-scale fundraising. He will cover best practices and give us his insights on raising capital during these socially distant coronavirus times. It is my pleasure to introduce Evan Katz.
Well, thanks, Dorothy, and thanks not only to you, but also to the Penn Club and to the Bulls and Bears Hedge Fund Society. It's been one of my favorite groups at Penn, and I think I've been coming for, well, probably since you started many years ago. So thanks to you and to the Penn Club. Initially, as Dorothy said, we're going to be talking mostly about raising capital during a pandemic, which for several months was a complete contradiction in terms. One thing I should mention is on our website, there's actually a nice PowerPoint if people would like to download it regarding how to raise capital for alternative investments in general, pre-pandemic. It's on the Crawford Ventures website, crawfordventures.com. It's about halfway down, and it's a PowerPoint with about 44 tips, tricks, and best practices to raising money for alternative funds, hedge, real estate, private equity, and venture capital. Generally speaking, I may actually update that a little bit to throw in a few more slides about the pandemic, and if I do, I'll send a copy to Dorothy and she can circulate it. But in the meantime, if anybody wants to get the pre-pandemic version with about 44 best practices, it's downloadable on the Crawford Ventures website, and I did throw my contact information into the Zoom chat. As Dorothy may have said, I think we're going to hold questions towards the end, and then maybe we can even have a conversation. And if people want to stick around, I actually will get a glass of Cabernet, not just what's in the coffee cup now, which is basically just coffee. So as Dorothy said, I'm managing director of Crawford Ventures. We help build and raise capital for alternative funds, hedge funds, private equity, venture capital. I've been doing this for about 15 years. Have built over 15 years relationships with about 1,000 institutional family office investors. They have about $6 or $7 trillion of capital, and they allocate obviously hundreds of billions to hedge funds and alternatives, typically about $10 to $100 million per investor per fund. So putting aside the commercial, let's get to COVID. So obviously, everybody in the hedge fund alternative investment space was minding their own business in January and February of 2020, doing what they do, trying to put up good numbers, trying to raise capital in the normal course of business, at least since the 2008, 2009, 2010 crisis. I will never forget the date of the last hedge fund event I went to before COVID. It was March 6, 2020. It was it was an Opal Alternatives Family Office Cap Intro type event. It was March 6, 2020. There were signs. Some people may not want to shake hands because of this thing called coronavirus. The room was packed. There was no social distancing. There were no masks. And most people did not shake hands. Of course, we all know what happened after that. For the rest of March, April, and probably much of May, nothing happened. People were trying to figure out whether their kids could go to school, what an N95 mask was, how to spell coronavirus, and basically, is it safe to leave my house or apartment, or should I just stay inside for the next what we thought would be the next couple of months? And frankly, everything was pretty much, I think, on hold on the fundraising space as well. I mean, as I said previously at a conference, if a hurricane comes through and it's going to be a week or two or several weeks, people just stop doing business, which happens in Cayman, down in the islands. So people thought this was going to be a couple of weeks. Who knew, a month or something, and everyone just shut down. So no great insights here. I think for March, April, and May, we had some investor calls, some this and that, but it was dramatically reduced. But then something happened, and that was that everyone from government people to healthcare people to hedge fund people and investors realized this is not going to be a hurricane or a tornado or a month or so. This is going to be protracted. And investors had two choices to make, or maybe three choices to make. One, they could not do any investing for what clearly people came to see as the next 6, 12, 18 months, or who knows when. They could make no new investments. And that's not a great alternative because they need to put money to work, and to sit on their hands for a year is probably not acceptable. The second alternative was they could only make investments with managers they already were invested in, but that's not great because there's a lot of great other managers, and for diversification purposes, simply increasing your allocations to your current managers is probably not going to be a great idea. I guess there's a third option as well, and that would be to only give assets to managers they had met with before the pandemic, and we'll get to that in a second. And the fourth option, which most people have done, is to roll up their sleeves and basically say, we're going to have to try to conduct business as usual, even though things with coronavirus were anything but usual. And having spoken to many dozens of hedge fund and alternative investors since then, pretty much 99% are basically in category 3 or 4, either allocating to managers that they've met before, or where they know somebody already on the team, or the fourth version, basically doing business as usual, but obviously conducting ODD and meetings by Zoom and so forth, and we'll get into that in a second. So, at this point, certainly by the fall, certainly by September, October, November, December, what we've been seeing is that the overwhelming majority of endowments, foundations, pensions, family offices are getting used to the new normal, so to speak. Everyone, of course, has become a jockey at Zoom. Everyone has the technology. And I'll get to in a second. Also, a lot of the industry has caught up as well. So I will say that nothing good has come out of coronavirus, but if there is a small silver lining to the pandemic, it's that the industry and the cap intro companies and the conference providers have scrambled, for lack of a better word, over the summer to build or enhance their technology, where there now are cap intro events, formal, informal, large or small, happening on a virtually monthly, if not more than once a month basis. So before, as many people on the call know, a lot of the cap intro was done with the classic spring, summer, fall events in Manhattan, and of course, everybody's favorite winter events in Florida, where there'd be family offices and institutional investors, and everybody would hop on a plane or take the subway, depending upon where they lived, and get together in person, call it 4 times a year, once a quarter. But the reality was, of course, that nobody could hop on a plane or was going to hop on a plane every single month, much less every other week, to do cap intro. They didn't have the bandwidth. It just was a complete non-starter. But what we've been seeing is, in the past 6 months, a lot of the major, both for-profit and not-for-profit entities have built out pretty robust and sophisticated virtual cap intro event systems. And some of them charge, but the bottom line is this: we've been participating in 1 or more cap intro events with investors, aside from our one-on-one calls and our one-on-one meetings, on virtually every other week or every third or every fourth week. So it's been extraordinary how the industry has pivoted, and over several months of probably working 24/7 have got these systems up. So incredibly, after going through March, April, and May, where cap intro and fundraising was down, there's no number, but let's just call it 75, 80%, post-summer going into the fall, what we've actually been hearing from allocators is that allocations are at least back where they were, close to it, or possibly even more, because although investors can't meet face-to-face with managers, they probably already know someone on the team, and they've come to the realization that you can do about 95% of ODD and due diligence virtually, although it is bizarre to potentially give someone $50 or $100 million, more or less, that you've never met in person and never shaken their hand and looked into their eye. But I think the industry's come to realize a couple of things about that. People talk about the Madoff fiasco and debacle. Small fun fact: I actually grew up with Bernie, Mark, Ruth, and Andy Madoff. They lived about a mile or two away. I went to the same high school and grade school as their kids. And the problem, of course, needless to say, in hindsight with Madoff, wasn't that he didn't have a great office. He had a beautiful office in the Lipstick Building. The problem was what he was doing and the lack of great auditors. And of course, the whole thing was a Ponzi scheme and a house of cards. So, while it is unusual to allocate money to managers you've never met with or seen their office, the problem with Madoff was not his office. The problem with Madoff, was Madoff. So what we've been doing now with, ODD and allocations in the virtual coronavirus time is, similar. It starts off similar to the previous world before COVID, of course. Obviously, pick up the phone, call allocators we know, pitch them a fund, XYZ Capital, ABC Capital, great team, great track record. Here's how they're different. Sounds great, Evan, or whoever's raising the capital. Send over the docs, email the docs. And then typically after that, it's pretty much step 2 has been pretty much the same. The conference call with the team. And maybe there's another one after that. But then after that, everything has gone Zoom. And, a couple of practice points I will throw out to people trying to raise capital during the COVID pandemic. Some of it is obvious, some of it isn't. Although if it were obvious and everybody were doing it, I probably wouldn't be highlighting it and talking about it now. If, no one needs me to tell them 2 + 2 is 4. One of the things is pretend it's a meeting. So, you wouldn't show up at a meeting, with a casual polo shirt or a t-shirt or whatever the equivalent is. Put on a nice shirt, make sure your hair is combed, put on a jacket. I will draw the line at neckties. Somebody showed up at a Zoom meeting with a necktie and it was just way overkill. My own personal taste is don't wear a suit and tie to a Zoom meeting. It just looks ridiculous, but at least, dress the part. The second thing is the team should have a solid background. Dorothy, unscripted, complimented the Crawford background that you're all seeing. I have got to say, in 15 years on Wall Street, the greatest compliment I've ever gotten for anything has been our Zoom virtual background. There was about 10 different versions of it, some with different colored letters and different size font and different, you name it. It has gotten more compliments than anything I've ever done in my life has been the Zoom background. So if you're raising money for your hedge fund, your real estate fund, your venture capital fund, I'm being quite serious. Have somebody who knows what they're doing, come up with a background so you look professional. Is it essential? No. Are people going to throw money at you because you have a great background? Of course not. Would people invest with you if you had a horrible background? Some probably will. But what's the old expression? You never get a second chance to make a good first impression. And every little thing you can do, from having a good haircut, having a nice shirt and tie or whatever, maybe skip the tie, and having a nice background, it helps. The other thing is, and I say this from experience, is please, please, please invest $100 to $200 in a decent headset. I have been on some Zoom calls with fund managers talking to multi-billion-dollar shops that are considering putting $50, $100 million with a manager. And the first time this happened to me, there was a manager who had bought I won't use the phrase, the initials are POS headset on Amazon. He paid $40 for it. You couldn't hear him. There was an echo. It was horrible. And the guy's asking for $100 million from an allocator, and you couldn't hear him. So at this point, whenever we raise money for funds, we do sound checks. We get on, we do the backgrounds, we make sure everybody sounds good. The other big mistake is the computer speaker. Most computer microphones and speakers are horrible. Again, I'm not saying you need to have CNN at home with a full studio for $100,000 like you're the CEO of a publicly traded company. But seriously, invest a couple $100 in a good microphone, a good camera, and that sort of thing. So that's a few practice points from OD during the time of coronavirus. Other issues that have come up have been sort of interesting. Most documents, of course, can be shared. Your pitch book, your one pager, your PowerPoint, your DDQ, things like that. But there are some situations where you have the super duper double secret confidential documents you don't want out of the office. And the question has come up, how do you share those documents with investors over Zoom or any other way? In other words, the documents that you would show them in an office and leave on the conference room table that they could look at, whatever those are. Maybe it's your latest SEC audit and deficiency letter, hopefully nothing bad. whatever it is, what do you do with those? And it's been a challenge because there's no, you can't have your cake and eat it too. There's been no real great solution for that. It's probably gotten broken down into a couple of categories. One category is, screw it. What can you do? We'll send you the documents. You signed an NDA, you didn't sign an NDA, but we'll send you the documents. Keep them confidential and don't do anything with them. That's one alternative. There have been some other alternatives where people have literally, myself included, have held the most confidential documents up to a computer screen and taken people at their word that no one's taking a picture of the document on the computer screen, which you could probably see anyway, or screen sharing it. There's been versions of that. But that has been tricky. But at the end of the day, I think people have come to realize that most of these super top secret documents are not as super top secret as people have thought. And, unless it's the trade secret formula for Coca-Cola, better to get the $100 million allocation during coronavirus and hold the document up to a screen or let people take copies of it. One thing I should also mention too about documents, it should go without saying, sometimes it does, sometimes it doesn't, about the virtual data room. If there's ever been a time where you want to have a virtual data room, which surprisingly a lot of funds still don't have, now is the time. There are a lot of companies that provide virtual data rooms. A lot of administrators provide them to their clients. Other third parties have wonderful virtual data rooms. So in addition to emailing the documents, which I always recommend, that's great. It's also good to have the virtual data room. So if they ever need to go back, they can have all of them in one place and find them at their leisure. One of the big reasons they always say to always email documents in addition to the data room is that investors are also often flying places and they may or may not have Wi-Fi. So if they've got their email and your email with your documents on the airplane, even if there's no Wi-Fi, they have access to your documents. Of course, nowadays with COVID, that has become much less of a consideration. I was going to say, Dorothy, maybe let me stop talking for 30 seconds. Any questions come in so far about COVID, ODD, raising funds during a pandemic or anything?
No questions so far, Evan. I did want to ask you a question, and you're probably going to cover this, but which types of funds are requesting assets right now, requesting capital, and how does that differ, or how is that the same than pre-COVID?
Dorothy, I'm smiling and nodding because literally the next bullet point on my outline was exactly that. This was not planned, but great stuff. Great question. So, I'll answer two questions. One is what funds are looking for capital, and two, where investors mostly focusing their attention. Well, in terms of which funds are looking for capital, the answer, I think, from the days of the SAT is, of course, E, all of the above. I once asked a prime broker if they had any great clients looking for money, because we had a lot of investor relationships. They said, Evan, every client's looking for money. I said, okay, fair point. So it's everybody. Hedge funds, real estate funds, private equity, CTAs, CPOs, you name it. I think certainly, though, out of those, real estate is at a very interesting inflection point. The number of folks who think they're interested in real estate funds may be lower because of COVID and the issues that a lot of the cities are having. On the other hand, as Rothschild said a long time ago, you buy when there's blood in the streets. Or, I'm not that old, but I was around for the 2008 crisis. And some of the best investments I'd ever seen made were made in 2009 and 10 during the crisis. So, but aside from real estate, which is its own highly impacted by the crisis, probably more than anything, hedge funds are raising capital, venture capital. Things haven't missed a beat. Again, March, April, and May, people were just trying to figure out what to do with their lives, much less their business. But after that, it's picked up tremendously. The answer to, I guess, the second part of your question, Dorothy, is where are allocators looking to invest now? It pretty much is everywhere, but there's a couple of lessons to be learned regarding COVID. The interesting thing about hedge funds, one of the interesting things is that for the last several years, people love to paint with a broad brush. And they've been saying, well, hedge funds have been underperforming, and we all read this stuff. And my answer to that has always been two things, both of which, no, you're being ridiculous. First of all, there's 8, 9, or 10,000 hedge funds. So you cannot possibly say how are hedge funds doing. The top quartile of hedge funds are doing great. The bottom quartile are doing badly. People say how are hedge funds doing? It's like asking how are football teams doing? Well, football teams are 500. They're winning half their games and losing half their games. You only care about how a specific football team is doing, your favorite football team. But people still do it. They say, how are hedge funds doing? As if they were all doing great or poorly. But that said, with the S&P and going straight up almost, and quantitative easing and easy money, some people have said hedge funds are underperforming because they're making a poor comparison. They're comparing hedge funds to a kind of straight up QE induced bull market, as opposed to 30, 40 years in multiple market cycles. But a lot of people make that mistake, and even the Wall Street Journal talks about it. So even buying to the premise that hedge funds were only doing okay, or many of them were only doing okay, things changed in March. In March of this year, when the psyche of investors and the psyche of people in Wall Street finally took hold that this is for real, the S&P was up, I think it was around 13 or 14%. And all of a sudden, people woke up and said, oh, wait a second, the S&P can go down a lot as well as go up? Gee, wait a second. And so we started seeing a couple of things. We started seeing a lot of investors, even sophisticated ones, saying, gee, I should really be making sure that I've got some great uncorrelated hedge funds, or for that matter, any uncorrelated strategies, litigation finance, life settlement, some private equity and venture funds that tend to be uncorrelated or less correlated. I mean, you name it, that we have some more uncorrelated strategies in our portfolio because they had this wonderful wake-up call that the S&P was down, I think it was 13 or 14% in March. So we started seeing a market uptick for hedge funds or less correlated funds in general, whatever the underlying strategy may be, number one. Number two, specifically hedge funds that are less correlated or uncorrelated. For example, one of the Crawford affiliated funds was up 23% in March of 2020 when the S&P was down 13 or 14%. So, if a fund ever wanted something to put on a billboard in Times Square or to take a Super Bowl ad by, it's being up 23% when the S&P is down 12 or 13%. And so we saw a lot of increase in requests for less correlated managers or uncorrelated managers or negatively correlated managers. It sort of brings to mind Warren Buffett's famous quote, and he's had several, and I think he coined this one, or maybe he just repeated from somebody else. You only know when the tide goes out who is swimming naked. And that's what happened in March of 2020. And another thing I'll add to answer to your question, Dorothy, is not just the role of uncorrelated or less correlated funds, but also the role of emerging managers. Emerging managers are a hot topic. People have been discussing emerging managers for 15 years since I went to Wall Street. And everyone seems to know that emerging managers in the hedge fund space, at least maybe in venture and PE too, tend to outperform established larger managers by approximately 100 to 300 basis points a year. So say roughly 200 basis points a year on average. And obviously that's a lot of money. That's a lot of return on a 1 year basis. Start compounding it, it gets to be, even more. So what's it got to do with COVID? Well, it's easy when the markets are going straight up and hedge funds are going straight up to throw money at the biggest and best known funds, the big marquee names, the old expression, no one ever got fired for buying IBM, which basically I guess means, no one ever got fired for investing in Paulson, and not to pick on John, but or any of the major funds, Bridgewater, whomever. But the interesting thing is that not only do emerging managers tend to outperform by a couple hundred basis points a year, but they tend to actually be less correlated. Again, exceptions in every direction, but they tend to be a little bit less correlated, a bit more nimble. So we also saw not only an uptick for less correlated or uncorrelated or negatively correlated funds in general, but a bit more open-mindedness, to emerging managers in general. And I think I still have a report I did a couple of years ago about how emerging managers tend to outperform. If anybody wants to put in the chat, not only a question or two generally, but if they want a copy of that paper, of that white paper, I'm pretty sure I can find it on my hard drive and dust it off or cross out a name or two and send it over. So that's sort of, does that answer your question, Dorothy, about the strategies and emerging managers?
Yes, thank you. And you touched on real estate. Any influences that are different than pre-COVID period?
Sure. Well, yeah, the real estate situation is, of course, intriguing. Just like a lot of hedge fund managers tend to do best when there's volatility, because in the straight up market, anyone can pick stocks, just throw a dart. And hedge funds tend to do better when there's more volatility. Same thing on the real estate side too. We have seen some opportunistic real estate funds come up that are looking to opportunistically acquire property or to repurpose property, maybe to warehouses for online fulfillment. Think Amazon and things like that. We've seen a lot of that in the real estate space. So people are now realizing that you do buy when there's blood in the streets, and there are some opportunities in real estate. Some of those include the so-called opportunity zones. If people know the recent opportunity zone legislation that came down, if not, email me and I can explain what that is, or just Google real estate opportunity zones. So some of it's been there and some of it's been more general, but we have seen an uptick in interest in opportunistic real estate. Although it's interesting, it's kind of like emerging managers. Most allocators know emerging managers tend to outperform established managers, but even though everybody knows it, most allocators are too chicken to actually allocate to them. So, I actually took a look, I think it was maybe a couple months ago, out of the 1,000 allocators we work with, probably about 150 seriously focus allocate to emerging managers. I think it's the same thing on the real estate side. A lot of investors know that there's some great opportunities in real estate when the world is coming to an end, but a lot of them are just not going to be too keen, to dip their toe in it. Maybe chicken's the wrong word, conservative might be a better word, but they're just not going to dip their toe in it. The other thing also too is, what happens when things get back to normal? So, I am not a real estate expert, but suffice it to say, to paraphrase, was it Mark Twain's famous quote, the death of New York City, the death of Manhattan has been greatly exaggerated, because the end of COVID and the return to somewhat normal life is not a question of if, it's a question of when. So, as people have been saying about the economy, as opposed to 2008 and 9, where there was huge problems, fundamental problems with subprime and over leverage and so forth, the COVID problem economically is really COVID. So when cures and vaccines come in and people start going back to work and are in the office more days than not, again, I'm not a real estate expert, but presumably New York will quote unquote come back and rebound. Whether the movie theater business comes back and rebounds now that everyone's got more Netflix and HBO than they know what to do with, I don't know. But the real estate market probably will too. So, in terms of opportunities in real estate, to the extent you can get things quote unquote on the cheap and be somewhat patient capital, this certainly may be the time. I recall back in 2009, 2010, a lot of investors were buying up, let's call it the real estate of its time, which might have been certain bonds or that were trading at 30, 40, 50 cents on the dollar, where they were positive they were worth 60, 70, or 80 cents on the dollar, and they were absolutely right. And in whatever the time frame was from when they purchased, 18, 24 months, they went from 30 to 60. They did quite well.
I had another question, Evan. Is it a good time to start a new fund? And if so, could you take us through the capital raising cycle?
Sure. Well, as a former recovering lawyer, I guess you're always a recovering lawyer, I will give you the Harvard Law School. They teach us this at Harvard Law School. The Harvard Law School answer, and most people could probably guess it. Well, that depends. It depends. So I'll say this much. It's probably no worse of a time to start a fund if you have the requisite prerequisites. So let me give you the longer answer to your short question, Dorothy. I often said the one great thing about the alternative investment business, whether it's hedge, private equity, venture capital, real estate, whatever is that you can form a fund with two guys, a gal, a dog, and a Bloomberg. That's the great thing. You go to your local alternatives lawyer, you can start a fund, two guys, a gal, a dog, and a Bloomberg, and you're up and going in a month with a couple of service providers. But the problem is, though, where do you go from there? In other words, to maybe mix metaphors, you can get to first base really easy. It's a lot harder getting to second, third, and home. So what are those prerequisites? And I think it's all the stuff that everybody knows. It is a good team, typically, hopefully not just the one man or one woman band. Those are always hard to raise money for, no matter whether it's 2008, 2015, or 2020. So at least a couple of people, a good compelling story. Who are you? Where did you come from? What is your expertise in hedge or venture or private equity or real estate? Do you have a track record? Is it portable? And that's a 3-beer conversation, the portability of track records. Won't get into it now. Who are your service providers? What's your strategy? How are you going to make me money and mitigate risks? So we all know that. That's pretty standard fare. But I would say that the two big differences, and it's a great question, thank you for asking it, are twofold. Number one, it's always critical, and it's in the PowerPoint on our website, it's always critical to have somebody on your team who already knows investors. And again, I'm talking my own book a little bit, but whether it's us, someone hires, there's a lot of great fundraisers out there. If Mo, Larry, and Curly form a fund and they don't know investors, do not try to roll your own. We've actually done studies on this. Fund PMs who just cold call or cold email investors, the response rate is infinitesimally lower than if someone who already has a relationship with these people, like we do, and there's others besides us, call and email those investors. To begin with, a good fundraiser will know investors 5 to 15 years. And the best kept secret or the worst kept secret on Wall Street is that hedge fund and other alternative allocators get hundreds, if not thousands, of pitches every single year. So if they get an email or a phone call from Mo, Larry, or Curly they don't know, the worst kept secret is they probably won't even read it. They probably won't even get to it. If they get an email or a phone call from Evan or Billy or Susie, whom they've known for 15 years, who only and always shows them good stuff, they read it. Whether they invest or not is a different story. So in 2020, Dorothy, post-coronavirus, during coronavirus, it's more critical than ever to make sure that one of your partners or one of your fundraisers or somebody has these relationships with investors already, especially because, like I said at the top of the call, the chance, even if you get on an investor's radar screen, the chances of an allocator allocating to a fund where they've never met you before or anybody is probably slim to none. Not none, but it's slim. And getting a great fundraiser, if you can multiply that by 10 or 100, is certainly worth the cost. The second thing is longevity. The great thing about funds is, as I said, you can start one with 2 guys, a gal, a dog, and a Bloomberg. The bad thing, again, is where you're going to go. And part of the longevity issue is operating capital. Let me explain what I mean by that. If you, Dorothy, and I were going to form the world's greatest Italian or French restaurant post-virus, we go to our local accountant who knows the restaurant biz, and they say, Dorothy, Evan, first of all, you're going to probably lose money with your restaurant. Second of all, you got to put up $2 million. Here's the expenses. You're going to probably lose money, but if you make money, you got to put up $2 million of operating capital for people and rent and so forth. And if we don't have it or we don't want to put it up, it's a short conversation. We go back to doing what we do with our day jobs. The problem with the funds business is, as I said, you can get in very easily, but where do you go? And the problem we see is a lot of emerging managers especially start a fund, but haven't squirreled away a couple of $1 million of operating capital to get from first base to second, third, and home. Because unlike the Italian or French restaurant, they can start with $100,000 or less and get online and get going. And the problem is it creates the chicken and egg situation. Investors don't like to invest in a one-man or one-woman band, but the one-man or one-woman band says they can't afford to hire a CFO or an analyst yet, or a fundraiser yet. So they try to do everything themselves, or they, and I'll use the word, they outsource everything. And that's the conventional wisdom. You don't need a CFO. You can outsource that. You don't need this or that. You can outsource that. And the truth is, yes, you can outsource everything. We live in an outsourcing world. There's TaskRabbit and Fiverr and all these things, and you can outsource your cooking, your cleaning, your research, your fundraising, your CFO, and everything. But the problem is when allocators look at your fund and 3 funds with return streams close to, better, or even slightly worse than yours, and the other funds have an internal CFO who's there every day or 3 days a week or whatever it is. And instead of being a one man or one woman band, they've got 3 or 4 people, everything else being equal. Even if their returns are even not quite as good, where's the money going to go? It is probably going to go to the fund that has 3 or 4 people and a real team and a real infrastructure, at least consistent with their size. No one's expecting a $50 million fund to have 50 people in risk and and all that. $50 million fund, but they should have a few people and so forth. Yeah, there's a funny story once. I was at a hedge fund cap intro event and sitting next to a guy. I'll leave out the name of the firm. They're about a $9 or $10 billion shop, and we were chatting with the head of the firm, chatting with him about what was going on. And he said they recently had hit $10 billion. So they were just able to put in some great system that a lot of their investors were asking them to put in. And I looked at him and said, Jeff, his name was Jeff. I said, listen, no offense, but when you were a $10 billion shop, you couldn't afford that system. Only when you became a $10 billion shop, you couldn't afford it when you were a $9 billion shop. So again, no one's expecting emerging managers to have the systems of a $10 or $9 billion shop. But more importantly than ever during COVID, A, have people who know the investors already, and B, have a couple of $1 million of operating capital so you can hire a few people and become attractive to investors. And I'll say 1 or 2 more things about this. Nobody's saying you've got to pay everybody market rate when you're an emerging manager. But if you have some operating capital, we've done this before. We've done CFO searches. Most new employees will accept, I call it the Evans special. Most service providers will work for half price for a couple of years. Most employees will work for, call it half of the usual rate for a year or 2. So long as they've got a contract that says when the AUM gets big, we get brought up to speed, plus a bonus for taking the risk. People get it. And most service providers and most CFOs and most employees will work at half price for a year or 2, so long as they know there's a light at the end of a tunnel, and they get a big bonus when we all sort of cross the $100, $200, $300 million range into the promised land and get caught up. But you need to have a couple $1 million to get there. And the last point on this, and I'll ask again the group or you, Dorothy, if you have any more questions, is, well, what if I don't have it? Now, that is a bit of a conundrum. If you're a great PM who's got this great track record, and especially if you've come out of Brevin Howard or Bridgewater or Izzy or Stevie or some major shop, you should have a couple $1 million to put at risk to build your business. You probably should. Some people don't want to, but you probably should. Okay, maybe not. Maybe you came from a smaller shop. Maybe you were underpaid. Whatever it is, maybe you don't. So then I would say if you're an emerging manager and take nothing else from this call, and it's in the PowerPoint on our website, I would say probably the number 1 best kept trick in the book is if you don't have the $2 million to put up to build a team to get to the promised land, in addition to raising money from your friends, the 4 Fs, friends, family, former colleagues, former investors, in addition to the 4 Fs, go to them and sell a piece of your firm for a couple of $1 million. That is not LP capital, not just sort of the regular generic investor capital, but sell a piece of your management company, the investment advisor, the general partner to your friends and your family for a couple $1 million. Because at the end of the day, which is better? If people can take out their Excel, their pens and their paper, do the math, which is better? Is it better for you to own 100% of a hedge fund or a PE fund that's running $10 or $20 million, or 80% of a hedge fund that's running $300 million? And of course, the joke is you don't need Excel to figure that one out. So probably the best kept trick that most people never do is go to your friends, your family who know that you're smart, you're honest, you're hardworking, that you truly did this great job at your old firm, even if the track record is not strictly portable. Raise a couple $1 million. So now you can hire a CFO, you can hire a fundraiser, you can get a good auditor, you can get a good administrator. You can basically make yourself investment worthy. And at the end of the day, if you only end up owning 75, 80% of your fund and you hit $1 billion 5 years sooner than you would have otherwise, it'll be the best trade you ever made in your life.
Good thoughts. Good thoughts. Does anyone have questions? I don't see any in the chat room, but we would like to. We want to make sure your questions get answered. And if anyone has a question, just raise your hand and we can unmute you.
Yeah, and we may actually do a bit of an unmuted sort of, I won't call it a happy hour, but happy hour Q&A, happy holidays thing when we're done with the Q&A. While people are thinking of questions and raise a hand and Dorothy can unmute and so forth. One thing I also wanted to mention, like a lot of the rest of the world, we have become increasingly focused on diversity and inclusion. And sometimes we do get these questions from managers, established, emerging, and whatnot. Are our investors looking for funds that offer diversity and inclusion in ESG, women-run funds, women-owned funds, minority-owned funds, minority-run funds, and what our thoughts are on that, and probably, frankly, more importantly, what our investors' thoughts are on that. So let me say just maybe two things while people are coming up with questions. The answer is it does make a difference. It's a thumb on the scale. I mean, at the end of the day, investors have one mandate to invest in managers that provide them with stellar, top decile, top quartile, risk-adjusted returns for funds of their strategy, size, and style in their asset class. That said, everything else being equal, and it rarely is, but everything else being equal, a lot of investors are paying more and more attention to diversity and inclusion, especially some of the public pensions are paying much more attention to that. Also, the private endowments and foundations are paying much more attention to that. So the way I phrase it is this, I do not lead with, here's a great fund, they're owned or run by a woman or a minority PM. Because I think when you start with that, it almost may imply that there's not much behind it. But I will, when we raise funds for funds, we raise capital for funds, they typically have about a 6 to 10 point bullet point that goes to investors about the team, the track record, the pedigree, the service providers, all the usual stuff. In the case of diverse funds, PowerPoint or email slide, PowerPoint slide number 1 or bullet point number 10 is going to have something that there is women or diverse ownership at that firm. So if that is certainly a bit of a thumb on the scale. And one more point to mention regarding diversity, women, and coronavirus. And you may say, what in the world do women and coronavirus have to do with each other? There was a very, very interesting studies, 2 studies actually, that are worth mentioning together. There was several studies that have been done about women hedge fund managers. Do they perform better? Do they perform worse? And again, going back to hedge funds, one can never say that women-run funds perform better or worse. There are tens of thousands of hedge funds, fewer women-run funds, but there are great women-run hedge funds and bad women-run hedge funds, and the same thing for men. No difference. But what the studies have shown regarding women-run hedge funds is they actually do, on average, tend to perform better, exceptions in every direction, than men-run hedge funds with one particular regard. And that is, women-run hedge funds tend to have less tail risk. That is, they have less blow-up risk. And don't get me wrong, some women-run hedge funds have blown up spectacularly. But it seems as though that women-run hedge funds have far fewer blow-ups than men-run funds because of sensitivity to risk. That whether it's the testosterone, the culture, whatever it is about men running hedge funds, they're a little bit overconfident and a little bit, on average, not sensitive enough to risk, which is, let's face it, how you end up with big tail risk and some kind of blow-up situation. If your investments are diversified, if your investments are less correlated, if you're not levered extensively, it's pretty hard to have a major blow-up. It's worth reminding people, Bear Stearns and Lehman Brothers and long-term capital didn't go under because they got all their calls wrong. In fact, probably in the history of hedge funds, there's been few, if any, hedge funds that blew up because they were wrong on all their calls, or the vast majority of them. They typically blew up for the same reasons: too much concentration in a company or a sector, too much leverage, not enough positions, or both. And women seem to be a bit more attuned to not making those, what are frankly beginners' mistakes. So what does this have to do with COVID? Interestingly, some studies came out over the summer and the fall looking at the response to COVID and the rate of infection and the rate of hospitalizations and death in countries that are run by men and in countries that are run by women. And you probably know where I'm going with this. The studies showed that on average, women-run countries had lower incidence of COVID infection, hospitalizations, and death than men-run countries because women were more sensitive to risk and appropriately, in this case, conservative. So the long answer to the point I was making before is we have investors that are looking for quality teams, quality track records, infrastructure, people, whether it's 2008, 2010, 2015, or 2020. But again, Dorothy, the big takeaways during the coronavirus are make sure you've got somebody who already knows the investors, whether it's me or somebody else. There's a lot of people who do, because if you're starting completely cold, it's going to be a long, hard slug. And make sure you have enough operating capital to hire people at the appropriate level and get good service providers. So when investors get your documents from a fundraiser who already knows them, it's not the one-person band, often the one-man band or the one-woman band, but it's a team that they can actually bring to their investment committee or to whoever's running the investments. I mean, look, that said, family offices, it's their own money. And sure, family offices, they can do whatever they want, it's their own money. But even they want to see typically a bit more than the one-person band. So I'll stop there for the moment. If you have any questions, either in the chat or with hands raised, or Dorothy, you've got any, you can let me know.
Okay, I don't see any in the chat room. And let me just check for raised hands here, see if anyone wants to ask a question. Like we're pretty quiet here. Don't see any.
Or while Dorothy is asking for questions, I mean, could people at least put in the chat, in addition to their first name, the type of fund that they're working with, or just so I have some idea who's, I was going to say who's in the room. I guess I'll still use that classic expression, who's in the room, even if it's a virtual room, but people maybe could just at least add that, what type of fund that they're with, and maybe if there's anything more to say, I could sort of tailor and focus it a bit more on that, although we've covered a pretty extensive amount of ground at this point.
Evan, I wanted to ask, some of the fund managers are migrating out of New York City. Is that having a huge effect on raising capital or competition? Are there any spillover effects there with some fund managers moving? I know Florida is a big location where people are headed. Members of this group actually have moved. At least one member of the group has moved there.
Sure.
Is this affecting the scene in terms of raising capital or competition?
Sure. Great question, Darcy. Thank you very much. So you're right. There's been a big push from a bunch of folks in Florida to point out to people several things about Florida. And my best friend lives there. We have a lot of family and friends there. We have a lot of connections, investors, and funds there. I had a 2-hour call with a family office guy today in Florida. So yeah, Florida offers 2 great things, or maybe 3: the weather, and no state income tax. So those are the 3 great things about Florida. And they have been pitching very aggressively to get fund managers down there. There's even several trade groups, hedge funds in Florida, and just general sort of government-supported Florida-based groups that have been trying to get people to come to Florida. And at the risk of saying anything publicly against them, the weather is great. But I would caution the following and make a distinction. People probably, many know ESL Capital, Eddie Lampert. Eddie Lampert and I grew up together. He was up the block, quarter mile away. And he moved ESL Capital famously to Florida, I think about 2 to 3 years ago. And my guess is the weather's better. And when you're making whatever Eddie's making these days, however many millions or billions, saving the income tax, it turns out to be real money. But the difference is Eddie Lampert and ESL Capital already were established. I think like a lot of funds, Eddie probably offered to move everybody down there. He'll pay your moving costs. And if you can move your team lock, stock, and barrel to Florida, and you're an established firm and investors know who you are, God bless, move to Florida. The weather is great. Although the August is not to my liking, but July and August aside, the weather's beautiful. The challenge is if you're an emerging manager, and I'm not the crazy New Yorker who says that New York is the center of the world and there's nothing else aside from New York. There's plenty of great cities around the world and around this country other than New York. But if you're an emerging manager and you're not ESL and you're not at $1 billion or $2 billion or whatever the number is these days, yes, investors are in Florida, and yes, investors go to Florida. but out of the 1,000 allocators we work with, out of the 1,000 fund of funds, endowments, pensions that we work with, 99% of them are within 100 miles of New York or come to New York 1 to 4 times a year. The percentage of allocators that go to Miami and Palm Beach every year, it's well north of 20%, but it's well south of 90. So, I've often heard emerging managers ask me, should I go to Florida? I save the income tax. And I said, you're right, you do, but let me get my math straight. And again, it's time to get out the Excel and the calculator now. So you're going to move to Miami to save New York City and New York State income tax, which if you're in a high bracket is whatever it is these days, 10, 12%, whatever it is these days. And now you can't write it off against your federal anymore. That may come back with Biden, but whatever it is, you're going to Miami to save 10 or 12%. But if you're in New York City, you could probably raise twice the capital in half the time. So is it worth the trade? Is it worth it to save 10% on your taxes if you're going to get half the business? And again, so the answer to your question, Dorothy, is if you're an established manager, the weather's great, you can save a ton of money. But if you're an emerging manager, if you want to catch the most hedge fund or private equity investor fish, you want to be in New York City because this is by far the largest allocator. It's the financial capital of the world, along with London and Hong Kong and other cities. There's more investors within 100 miles of here that allocate to funds than there are in Miami. So that's the long answer to your excellent but short question.
Thank you. We do have a question here. Are track records important to new launches? And what about litigation and for finance funds?
Okay, I think the question is the portability of track records. I think it says the portability.
Yes, the portability of funds.
Sure. Okay. Let me take a deep breath regarding the portability of track records. This is the classic case where Billy or Susie was running a couple $100 million at Izzy or Stevie or Brevin Howard or Bridgewater for many years. They were phenomenal. They come out of there. They want to raise their own fund. And just like the baseball player, if a baseball player gets traded from the Yankees to the Dodgers, everybody knows he batted .350 on the Yankees and this year and .310 another year. No big secret. But when Billy or Susie leaves Brevin Howard or Bridgewater or .72 and wants to open up his or her own shop, there are several issues, regulatory and contractual. So the first issue is let's say contractual first. Most people at those shops have these long 9,000-page agreements that say the track record's not theirs, they can't discuss it, they can't cite it, they can't do anything with it, and if they do, they give up their firstborn and they're shot at dawn. So there's the contractual provision that says that when Billy or Susie starts to run their own fund, they can't point to the track record. Then there's the regulatory compliance piece. Well, what is that? That's where the SEC says that when you say you have a track record and you came out of a prior shop, you need several things. The first one or two things may be easy to cover. And that is, well, number one, was it you who was pretty much pulling the trigger exclusively or predominantly? If you were part of a team of 10 and you were the junior analyst, there's no way in the world you can claim that track record as your own. If you were the sole person as PM, probably you can. And of course, there's a lot of gray area in between. The second crazy thing, though, is the last time I checked with the SEC and the rules and the regs and all the law firms that work in the space, technically, if you're quoting a track record, no matter who you are or where you are supposed to have the trading tickets to back it up. Now, if you're running your own firm, of course, you've got all the trading tickets and you should score all that stuff away for the next 1,000 years. But if you came out of another shop, I don't know, maybe I've met one manager that somehow had his or her trading tickets where they could actually show that they made 8 billion% a year compounded for the last 2 decades. Nobody has that. So if one is trying to quote one's track record, the best thing to do is to consult your really smart local funds lawyer, and I can recommend several who are extraordinarily good at funds law, and to see what you can do. Now, I'm a recovering lawyer, and the following does not constitute legal advice, but I would say one thing. I always tell managers, tell investors the truth, tell them what you're going to do, confirm it in writing, and if you're ever going to make any material changes, tell them in writing why, and in advance. So with regard to the portable track record, I'd like to think that if you tell the truth, the whole truth, and nothing but the truth, and you have something to back it up, you'll probably be okay with the SEC. So for example, if you have left a major shop and you maybe have copies of documents that show you made 22.5% a year compounded for the last 7 years and so forth, and you maybe have the fund audits that confirm that you did, you're not going to have the trading tickets. But will the SEC realistically bring an action against you or ding you for claiming a track record when you've got a box of documents, even if you don't have 5 boxes of documents? Again, ask your local lawyer. I disclaim giving legal advice, but I think the chances are slim to none. You know, they're a capacity constrained organization like every other organization. And, you know, if you steal 2 grapes in the supermarket, the police are probably not going to arrest you, and the DA is probably not going to indict you if you took 2 grapes in the supermarket. It's just not worth anybody's time. So I think if you have a bunch of documents that can show that you really did what you said you're doing, even if you don't have every trading ticket for everything, you're probably going to be okay from a regulatory standpoint. Then, of course, comes the contractual situation. Even if the SEC is not going to bother you, how did you leave it with your old firm? And a lot of this is personalities. You know, there were some old hedge fund complexes where it used to be maybe they would fund you themselves and wish you the best of luck. And some famously, you know, Stevie Cohn famously, this is pretty much public knowledge, would, the lore has it, love to invest in former managers. He got capacity rights in your fund before when you signed up with him. In other words, the day you walked in to SAC Capital to run money, it said, if you ever leave, I have the right, Stevie Cohn, Stevie, have the right to put money with you at reduced fees. You know, so there are some folks who will do that and will give you money to help you become successful, and they get a right to give you money and discounted fees and so forth. That's a wonderful problem to have. Of course, the converse also exists where, you know, whether you're a lawyer who left a law firm or a trader who left a hedge fund, how dare you do that? To hell with you and the horse you rode in on. And if you do anything outside of our agreement, I'm going to make your life miserable and sue you till the cows come home. Hopefully, most people are not like that. And so what most folks end up doing, again, this is not legal advice, talk to your local lawyer, is they will try to walk a very thin line between putting their entire putting their track record in their deck if it's not portable, with chapter and verse and every month and every year, to saying absolutely nothing. So they may walk the line where they'll just simply say they were at such and such shop, they were one of the top ranked traders there, they had mid to high double-digit returns for 9 out of the 10 years they were there, and to basically say to investors, this person really knew what they were doing. They were a superstar. They were in the top decile traders at Millennium or SAC or wherever they were. And then typically when they're in the office, there may be some documents on the coffee room table or the conference room table that just happen to be out when the investor's in, that may happen to have more details. But of course, that goes to the point I made a while ago during this talk. How do you do that during coronavirus? You're not in the same place physically. There's no conference room table. You know, how do you leave that track record out where people can sort of pass by? And maybe it's you hold it up to the screen and you make sure nobody's taking pictures. Maybe you don't. But at the end of the day, just, you know, people should take some solace. Investors aren't stupid. There's been a ton of great managers who've come out of major shops, and the investors know that if you were one of the top traders at SAC or Millennium or Point 72 or Bridgewater, you know what you're doing. You may not know how to run a fund. That's a different story. You may need a CFO and a fundraiser because you absolutely know how to run money. You may not know how to run a business. That's a different story, but you know how to run money. And like I've said to a lot of, you know, we've raised money and I've done fundraising for managers of most sizes and styles. And like I said to some of the emerging managers who've come out of major shops, just the very fact that you were at Millennium or Bridgewater or SAC for 7 years means you know what you're doing. If you were not a good money manager, if you were not a great money manager at one of those major shops, you would not have been there for 7 years. You wouldn't have been there for 7 months. I mean, some of them are famous for getting rid of you. One in particular, I won't name, if you had, a bad quarter or a bad month. So I think those are sort of some ways that people deal with the portable track record by putting some in the dock, some on the coffee table, the conference room table, if you don't have express permission to use it. And I won't mention the person's name, but if the person who did put that question in the chat wants to speak to me or email me or talk more offline about other ways of walking the tightrope on this, I'd be certainly happy to do it.
Okay, well, we do have one more question. How do you feel about niche funds that acquire control of corporate assets for revenue sharing?
Okay, sure. I'm not sure I understand the question 100%, but it sounds like some sort of opportunistic venture fund or private equity fund or direct lending fund. Look, at the end of the day, I think if it really goes back to the fundamentals. If the team has done it, preferably has done it before, has a great skill set, has a great track record, has a good opportunity set to practice the strategy today in 2020 and in 2021, all the power to them, Godspeed, go for it. We have investors that allocate to virtually anything under the sun, hedge, private equity, venture, any mainstream strategy. Once on a panel, I jokingly said that if somebody has the man or woman who can pick the horses at Pimlico, and we can prove this and audit that I will raise a huge money around this person who can pick the horses at Pimlico. I'm still waiting for that person to show up. No one's ever found that person yet. Although actually, there was once a hedge fund that came to us that actually was doing lawful sports betting in Las Vegas where it's legal. And they actually started a hedge fund where they had a great quantitative system that was putting up pretty good returns sports betting. Now, is the Harvard or Yale endowment or the New York City pension fund going to allocate to a hedge fund or some other fund that is doing legal sports betting? My guess is probably not. Although family offices, again, their money, they can do what they want. So, but getting back to the question of acquiring control of corporate assets for revenue sharing, sure. If they've done it before, if they've got a good team, why not? We've seen plenty of private equity and venture funds who do this. Funds that loan on intellectual property, funds that do litigation finance, as long as it's explainable, understandable, and reproducible. I was going to say, and does not involve cannabis. Well, cannabis is actually now becoming almost mainstream. So even if it does involve cannabis, the answer is sure. If everything else is there, there's virtually no strategy that we and other people cannot raise money for because investors won't allocate to it. Again, cannabis is still on the fence a bit. Life settlement, a lot of people think is somewhat dodgy because while it is totally legal, you're basically investing on when people are going to die, and some people just can't get their arms around it or have the stomach to do it. But pretty much any other strategy out there, there's an old expression, there's a cover for every pot. I think we have one too. If whoever posted that question, I won't say their name, wants to email me or call me, be happy to speak to them and answer anyone else's questions now if we have any more.
Very good. Okay. Well, I want to be respectful of everyone's time, but Evan has agreed to stay on for a few more minutes. Thank you, Evan. And I want to thank people who joined us tonight very much for joining us and wishing you a happy holiday, happy Hanukkah, Merry Christmas, happy Kwanzaa, and please be safe. I'm going to take everyone off mute. So if you want to stay around, Evan has offered to be around for a few minutes to take questions. Thank you very much, everyone. Very good talk, Evan. Thank you so much. It's wonderful.